Hello, everybody. Kirk Spano, and I am going to bring you my third quarter outlook right now. And I think that there are a couple of things that are clearly about to happen, and the main one is rate cuts are finally here. So I am writing that piece right now. Why don't we go through some of the data and information and think this through a little bit? First off, if rate cuts finally do get here, what are we going to hear about from the inflationistas? We are going to hear how inflation is coming back. Maybe, but probably not. This is the range of inflation over the last 35, 40 years. Now let's take a look at the month over month inflation rate is. Right now, it's just about zero. That's right, folks. Inflation is basically gone. A couple of years ago, actually, I believe it was 2.5 years ago, I wrote an article where I said that inflation would be transitory, but higher prices would be forever. And that's really what's playing out. So when you hear somebody say, well, I'm still paying more for this or that or the other thing, usually groceries, that doesn't imply that we still have inflation. It just means that the inflation took us to a point where prices are higher now. And we probably shouldn't expect food prices to come down. We probably shouldn't expect certain commodity prices to come down, although energy, which is super important, might surprise us to the downside. We'll see. We'll talk about that in a few minutes. But right now, inflation has basically ended, and that is why the Fed will probably lower interest rates. Now, one of the things that we should talk about a little bit here, at least, is the long-term trend in the M2 money supply. As you can see, it has moved in a pretty smooth path for a very long time, except that it popped up here during COVID and post-COVID, and has been leveling off and even coming down for the last couple of years. Now, this is hard to see in some spots, so I'm going to stretch this out a little bit. Back in 1994, Alan Greenspan tried to tighten the monetary conditions by raising rates. Initially rose the interest rate or lifted the interest rate from 3% to 3.25%. And we got a massive bond rout. So in 1994, U.S. Treasuries got crushed. And that caused a number of major problems that resolved themselves into the 1990s as we got the first technology boom. And if you'll see, the red line, the red checkered line that I have in there, is really the long-term curve for M2 money supply, total money in the economy, and it implies the size of the economy is growing. When we operate below the red line, we're trying to keep things nominally tighter, and we operate above the red line, we're loosening. That's where the term counter-cyclical policy comes from. During the financial crisis, we had just ticked a little bit below the red line here for a hot minute to cool off the housing market. That destroyed the leveraged bets on the housing market, and we got a crash. That also probably marks the beginning of the baby boomer retirement crisis, as the first boomers started to retire, and they could do so because they were probably pretty well off. But demographically, we started seeing more dependence on government programs. And they printed a bunch of money to get out of the hole created by the exploded leverage that had brought down the system. And when they tried to normalize into 2010 and 11, it didn't work. We saw another mini recession almost get off the ground. So they did more QE. And this is where we got the waves of QE through the 20 teens until in 2018, we tried to bend it down. And again, this is a little bit hard to see, but you can see that they tried to flatten things out. And by August, September of 2019, we had a crisis in the repo market that the Federal Reserve, they didn't call it QE, but basically they printed money in QE fashion to pump up the markets and keep us above the M2 trend line. I had maintained at the end of 2019, and if you can go back and look at what I wrote, I said that this had to pull back and that we were going to see a correction into 2020. Now, what happened? We got COVID. So we'll never know if I was right, that this was going to pull back to the red trend line and that we'd see, kind of a mini recession. I called it a skip straight recession. and I'll call it that again. I think we're going to get the periodic bad quarter. Usually it'll be the first quarter of the year for a number of reasons having to do with budgets and just really the digestion of the Q4 spending into the holidays. But COVID caused a massive spike in money supply. Why? Because we had never seen the economy just shut down, just stop. So they did that. And then for a couple of years, to aid in the recovery, they printed more. I have maintained that this was largely done to use a crisis to solve problems into the future. So really they pulled forward quantitative easing and fiscal programs that maybe weren't going to happen until the next big recession, which is probably going to be triggered by the baby boomer retirement crisis around 2029. Could be a little earlier, could be a little later, which is when in 2029 the last baby boomers get onto Medicare, and most will be on Social Security by then, other than people who are putting off taking their check until they're 70, or I think now they can wait until they're 72. But in the last 2 years, as the inflationistas have chanted about money supply causing inflation, and there's some merit to that argument here, the reality is for 2 years, money supply has come down and really has leveled off again, and seems to be getting back to the historical trend line. Now, we currently have about $35 trillion in debt, which is why I aimed this area. And this is also the area where the last baby boomers are dependent on social programs. So you should expect the money supply to follow this line roughly for the next 5 years. Now, what happens after that? Hard to know. I believe that we'll probably see the peak of the boomer retirement crisis around 2029. And then from there, you'll see the economy get stronger and stronger on the back of two things. One, millennials in their peak earning years through the 2030s. And we just had a big wave of immigration and more is coming. And that brings young families. And those young families augment the smaller Gen Z and whatever they're calling the generation after that on the population. So demographically, we can offset the aging of the US population with more babies, sure, but really, because we're not making enough babies, immigration. And we're going to need, as I have told you over and over again, we probably need 30 million more people in the country over the next decade. And a few million of them are already here, and that's great. If you were watching Wall Street Week last week or this week, they talked about the incredibly positive impacts of immigration on the U.S. economy. I believe that the Fed has been putting off pumping up money supply until conditions with inflation and employment both were saying the same thing at the same time, which is the economy is kind of in the Goldilocks zone. How do we maintain it? So if you are an FS Insights person, you have been reading some of their work, and the jobs market has started to soften. So we have seen the JOLTS number of available workers come way down. It's basically on par with where it was here, and it probably is going to dip a little lower. We don't want to see this, but anything in this range here is pretty good. What that means is that there's balance in the workforce, about the right amount of people looking for work versus the amount of jobs that are out there. We still have a pretty significant skills mismatch. We need a lot more skilled labor, and I think that'll be a slow grind. We've talked about this for years. It's just happening very slowly. I will say that I went to a lot of high school graduations this year, and quite a few of them are becoming electricians or carpenters or plumbers. A lot of them are getting into the skilled trades. So I think that that is very positive for the long term, but in the short run, the next few years, it'll still have some choppiness. But this shows that we don't have a major mismatch in the labor market anymore. This is really about where it belongs. A little lower would be okay, but if it gets down here, then we have a problem. Back in 2015-16 is when I said that we were kind of having a stealth mini recession back there too. So we want to be in this range on the available workers. And we also need to see some of them, most of them, learning how to do something other than, remedial labor work. One of the most important things that we're going to see is how the price of energy reacts to the various moving parts in the economy. And there are a lot of moving parts with energy. The first that we always talk about is oil, because that is a oligopoly driven market. You really have two oligopolies. You have OPEC, but then you have the US oil producers, which we've talked about in the last couple of months, how there's a lot of consolidation in that market, a lot of companies buying out other companies, and the fear is that they produce less oil because they're simply seeking to produce less oil and prop up the price of oil. I don't know that that logic entirely holds, because they still have to produce free cash flow. So is there a balance between price and how much oil they produce? Absolutely. Are they going to try to maximize things? Sure. But there is an imperative among American oil companies, which are very tied into the government, to produce oil so that they don't create a recession by pushing the price of oil too high. A price of oil that's ever been sustained over about $90 to $100 a barrel has almost always led to a recession. And then they make less money during a recession because demand for oil falls. The International Energy Administration Agency, whatever they are, put out their medium-term outlook, and it was very, very fudgeable, very flexible, because they indicated that any small change could impact their outlook. So their baseline outlook is that we are going to have ample oil through the end of the decade, and they didn't call it panic pumping, but essentially that's what they're describing, is that a number of nations, including America, are going to continue to produce a lot of oil. And we just saw another country drop out of OPEC. I forget which one it was. It was an African nation, I believe, such that, and Kazakhstan produced above their OPEC limits. You're starting to see countries realize that the energy transition is real, that demand for oil is hitting that peak oil plateau that I've talked about, peak oil supply plateau, and the peak oil demand plateau, both happening at about the same time. But that points to balance. So we should expect the price of oil to continue to operate in that $70 to $90 per barrel range that we've seen for a few years now, once we overcame COVID. But even before that, the price of oil had risen. I talked in 2018 when it was in the 60s that would get to 80. It got about there. Then we had OPEC pump a little bit more. And then we had COVID and there was a glut. But the range on the price of oil has really been 70 to 90 for a number of years. And we can show that right here. So back here, I talked about the price of oil getting up to 80, and it was about 60 at the time. Got there just about. Then it fell off because OPEC produced more. This was the double cross. This is when Trump promised more sanctions on Iran, didn't do it, and OPEC pumped more oil into that, and he kind of burned them. And then you had the crash with COVID. And then OPEC held back on oil production as shale was struggling, and the price of oil got way up here over 100. Shale stopped struggling in here, and now you've had range-bound oil for about 2 years, with the bottom being, right around 70, and the top being right around 90. I would expect, where's my shapes? Oh, there it is. I would expect price of oil to operate in this box there, price 65 on the low side, and I guess it could get up to 100-ish. This is a range right in here that has got some relevance. That's probably what we're going to see for a number of years, barring a recession, which would push it down, or a major oil shock, which would push it up. About 100-ish is probably high, 65-ish is pretty low, because at this point, shale producers stopped making much money, and they would just back off on new well development for a quarter or two. So this is probably the range, with a little bit up here and a little bit down there for events. Now, why is that relevant? Because if the price of oil stays range bound, you kind of have a sweet spot for oil companies to make money, but you also have prices high enough, and people are smart enough to realize that oil supply is eventually going to be challenged years into the future. They don't think about the panic pumping that we've talked about. They don't think about how nations will pump more oil in the short run to get a price because they worry about 10 and 15 and 20 years out. Saudi Arabia doesn't worry about that, but clearly Kazakhstan does, and some countries in Africa that have been dropping out of OPEC or just not following the rules, even though they don't necessarily drop out. And then you have the U.S. oil companies, which they're very profit driven today, especially with the executives getting paid today. So they're not likely to save oil for 20 years out. So over the next several years, if the economy remains good, you're going to see pretty good balance in the oil market as the energy transition progresses. And a lot of that alternative energy that's coming is currently being soaked up by AI and a little bit by crypto mining, but mainly by AI data centers. At some point that levels out. And really what I'm describing here is a situation where the markets adjust. So capitalism works. And that's something that I think that younger people have to hear is you can't really just mandate this, right? Because we've seen in countries that mandate that the economies fall apart because there are natural inclinations among people to try to maximize their station in life. And if that is taken away from them, they stop producing. So one of the things that the IEA pointed out in their base case was, look, even though we think the supply of oil will be higher than the demand for oil by 2030, a few things could change that. And one of the things that could change that would be faster than expected GDP growth around the world. I'm kind of on that side of the fence. I think as we build out AI and as we go through the energy transition, which is probably the biggest or second biggest transition in history from an economic impact standpoint, you're going to see the economy continue to grow. And meanwhile, there are countries all over the world that are building all sorts of infrastructure. It's not high margin stuff. It's hard to invest in and make much money, but they're building it. And if you're working with the companies, so you're part of the companies building it, you'll probably make money. Doesn't necessarily mean there'd be much to throw off the shareholders. So I throw that out there because people talk about, well, I want to invest in infrastructure. Well, yeah, if you're building the bridge or building the airport or you're working with the companies that do that stuff, yeah, but that doesn't mean that there's a 10 or 15 or 20% margin that can get passed on to shareholders. A lot of these projects operate at single digit margins, which means there's just not much to throw to shareholders once the executives take their cut. So how do you make money? You make money in the companies that benefit from all the infrastructure that's getting built out. It's just like you're going to make more money in the future, I think, investing in the companies that benefit from technology. If you take a look how the internet developed, the original tech companies spiked and then crashed. And some of them survived long term, but really 80%, 4 out of 5 of the companies that were part of the 1990s tech boom are gone. They're gone. They don't exist anymore. So you're going to see a similar thing here with AI. A lot of these companies that are talking about we're the picks and shovels of AI, well, once the AI models are built out, which is going to all happen in the next 5 to 10 years, and once the demand for replacement parts, essentially semiconductors, levels off and we go into a maintenance mode 5 to 10 years out, who's going to benefit? Well, AI becomes very cheap at that point, and the companies that use it well will do incredibly well. I believe that you're starting to see the very tip of the iceberg on that with industrial companies that are applying AI measures. We take a look at Ametis. What did Ametis do earlier this year? They finished off their microgrid and they used a Rockwell piece of technology to manage their solar microgrid and their refinery. So you're seeing companies adapt technology similar to the way they did 20, 25 years ago with the internet, but this time it's AI. And we're very early in that process. So if we can find industrial companies, and really any company, that's going to increase its margins as it benefits from AI that's getting cheaper and better, which is what is happening or is about to happen. It's getting better. It's not getting cheaper yet, but it will get cheaper in a few years. Interesting things happen. Over on the energy side, if the GDP grows faster, which I expect, then the base case for the IEA probably ends up being wrong, and demand for oil and supply for oil remain more balanced versus there being a glut of oil. I don't think there'll be a glut of oil because one, OPEC, and two, we talked about this when I got back from Fort Worth. The supply of oil in the United States is starting to become challenged. The only basin that is growing anymore is the Permian, the Bakken, Oklahoma, Eagle Ford, the Rocky Mountains. You go around to all the other shale basins in the country, and none of them are really putting out more proven reserves. Now, does that mean that they're going to shrink? No, they can maintain their plateaus for a number of years because the new oil replaces the old oil. And we think that that will go on for 5 to 10 more years as well. The Permian probably grows very minimally over the next 5 to 10 years, but it also won't shrink. So what you're seeing is over the next 5 to 10 years, the supply of oil in the United States is going to stop going up, but it's really not going to go down either. We are going to have a supply plateau in the United States on oil for the next 5 to 10 years. Even if we go heavily into the Gulf of Mexico in the next decade, all that would be replacement oil. So you can see that the balance in the oil market is probably going to be there for an extended period of time. So when you take a look at the margins that oil companies have today, and you hear Elizabeth Warren screaming about it, those margins probably don't go any higher, but they come down very slowly. And they come down slowly because the cost of getting the replacement oil will go up a little bit. We talked about high grading for years in the shale patch during the teens and the last several years. High grading, of course, is the oil companies getting the cheapest, easiest to get to oil first. Technology has gotten better. Again, now there's another jump with AI, so that the cost of retrieving the harder to get oil isn't going up very fast because technology is keeping that from happening. So we have balance in the oil markets largely because of technology, because I think GDP growth will be a little higher than projected because of all these transitions going on. And as AI matures and that build out comes to an end, we'll have to keep an eye on if there's a next thing. But if we build out the alternative energy over the next 20 years and AI over the next 10, those are two huge things that are happening at once. Can space be that big? Can space replace AI? Maybe. I don't think it'll get that big, but it could if we really start taking seriously towards the middle of the century, exploring outer space and colonizing it and things like that. That's pretty sci-fi even for me. So I'm not really looking at that as a major driver. But from a small number to a medium-sized number, still great investments in space. It just won't be on the macro level the giant driver that AI and the energy transition are. So over the next 10 to 20 years, as those two things play out, the economy should be pretty good, especially as the United States offsets its aging baby boomers with immigration. And that immigration will be easy to find because climate change is causing millions and millions of people to leave where they live. A lot of the population that's moving from Central America up the United States is, frankly, due to climate change. It's becoming very hard for them to have agrarian societies. So you should see the United States, which is full of open space, fill in a little bit. And I would venture a guess, and I've told you this before, I think the second ring towns around cities, so you have the city, then you have the suburbs, then you have a ring of towns that could become suburbs, then you get another ring of towns. And a lot of those towns are a couple hours away from cities, maybe only an hour. Like where I live, those cities are only an hour away, but they've shrunk over the last 30 years, 40 years. Why? Because of the industrial degradation in the U.S. economy. Well, what do we know about manufacturing in the U.S.? We have seen manufacturing investment in the last 3 years more than double in the United States. So the building of facilities to manufacture in the United States has doubled in the last 3 years. A lot of that has to do with the Inflation Reduction Act. So if you go and read this, you'll see some of the things that have been going on. I can show you a pretty interesting chart. This is real private investment in manufacturing structures. Has skyrocketed. These were the projections, and this is reality. Basically doubled since the Trump term. Now, is this going to level off? Absolutely. In the next couple of years, with interest rates coming down, it'll plateau a bit, and then I'd say by the end of the decade, into the boomer crisis, it's falling off. But this will be all of the new things that we needed to reshore jobs and become less dependent on China. Semiconductors in particular are part of that curve, but you really have a lot of manufacturing that's come back here as a part of the revised NAFTA. I don't even remember what they call it anymore. And really just the whole idea that started really under President Bush that we should reinvest back in America. So after 9/11, we had the big drop, and George W. Bush really started pushing for this. And then we had the financial crisis. Then Obama tried his best to fix it. Then it fell off. And what is interesting here is that during the Trump administration, investing in U.S. manufacturing, despite the rhetoric of America First, fell. Why? America First. Manufacturing investment fell. Post-COVID, we had all the relief programs, which I indicated earlier that I thought were for other reasons besides COVID, and there you have it. So now we're in a position where we can reshore basically everything that we need to reshore, and these projects are finishing up right now. We know the semiconductors are starting to come online by the end of the year and into next year in 2026. And all sorts of other manufacturing is benefiting from AI. People are more willing, and private equity is more willing to manufacture in the United States, knowing that the margins will be higher because of AI. And there's lots of tax incentives for building in the United States at the moment. And these are mainly Biden tax incentives. So we're in a pretty good spot here. Now, will the United States population get to 400 million in my lifetime? Probably. And that's good. We have no problem bringing 50, 30, 40, 50 million people in this country. Plenty of space. And as we build homes for them, that is also stimulative to the economy. So I really don't have the dire outlook long term that a lot of other people do. But I do see some major problems that we have to get through. It's just that the boomer crisis that I talked about 10, 15 years ago, when I brought out the slow growth forever theory, we have, because of COVID, pulled forward so many of the things that I thought we would need to do down the road that you're getting a smoother playthrough. Then as wealth transfers from the older boomers to the younger millennials and Gen Z, the velocity of money should pick up. Velocity of money fell off a cliff starting with that 1994 bond market route that I talked about. And as the baby boomers got older, velocity of money just continued to fall until COVID killed it. There was basically no velocity of money during COVID. What did that mean? Because every dollar only transacted 1.1 or 1.2 times. What I think you're going to see is the velocity of money gradually get back up to this normal area where a dollar transacts 1.7 times as it gets into the economy. So as the money supply goes up, and these dollars transact 1.7 times, you get a more robust economy into the 2030s. I think you probably see it flatten out here. I think we get one of my skip straight recessions, maybe a bad quarter at the start of 2025 or somewhere in 2025, maybe the first quarter of 2026. Eventually, that's going to be met with QE. I think we are on pace to see QE by 2026, 27. Last boomers get on the Medicare, we freak out about it. We have another skip straight recession, mini crisis, and then a lot of QE to fix it. And this will be the phase that will most resemble Japanification and probably last until the boomers start to be off of social programs. They start to die. So when you forecast this out long range, obviously you can't forecast events, but you can see that the velocity of money should normalize. It should come back up into this range. And with immigration, those that bring young families, that is something that pulls velocity of money up. And the millennials being in their peak earning years, through the 2030s, also will pull velocity of money up, especially since they started to invest a little bit earlier than their older parents. Now, they've had a harder time saving because their incomes adjusted for inflation were lower, but that's beginning to change a lot. As we've seen, professionals and skilled people in the last couple of years since COVID have really seen their wages do well. And in fact, they're beating inflation. Now, if you're low skilled, untrained, undereducated, we're trying to get your wages up to $20 an hour for basic labor. And that's good because it was down at 10 just 5 years ago. But it really hasn't offset inflation. It's kept pace, but it hasn't beaten it. So we still get to a point where education and skills drive earnings. And that won't change probably ever. But the velocity of money because of immigration and because of money shifting from the boomers to the millennials, should get higher over the next decade or so with some interruption. That will generally be met with QE. Now, what about the rest of this year? I think there's a couple of things that we need to keep in mind. First off, it is clear from the employment numbers and from the inflation numbers that the Fed can start lowering interest rates. Will Powell lower interest rates in July? I don't know. The market is forecasting basically 2 interest rate cuts this year, the first one in September. If Powell lowers rates in July, it could smell like fear, and the market probably wouldn't like that. So my anticipation in Q3 here is that the Fed comes off as very dovish in July and says, yeah, we're probably going to lower interest rates in September because all the numbers support it. There'd have to be a surprise for us not to do that. And for as much criticism as Powell takes, and remember, I didn't love him, I didn't love the appointment, I believe he's done a very good job. And your inflationistas will say, no, he printed money. So what? We had COVID, you had to print money. Anybody who doesn't have their head wrapped around that at this point just doesn't want to. COVID necessitated a response because we did not know what it was. Or we did, and we wanted to pull the bailouts of the future forward. Either way, it needed to happen, and it did. We got a bout of inflation, which has largely been tied to supply chains being disrupted. And for a very brief period of time, sure, there was a little bit too much money in the economy. But over the last 2 years, as I've shown you, that curve has gotten back closer to trend. And I would expect this period to look a lot like this period, a little bit above trend most of the time. And if we do get a reboot of inflation, they will just pull it back closer to the trend line. Now, here's the interesting thing. The deficit is about $1.9 trillion this year. The debt is about $35 trillion. Let's do a little math. 35 trillion, lots of zeros, right? Millions, billions, trillions, times an average interest rate of about 4.2. That's $1.47 trillion of interest that we're paying on the debt, give or take. The deficit's $1.9 trillion. What does that tell you? What is the logical path to reduce the deficit? To lower interest rates, right? Now, you have a lot of people saying that the neutral interest rate is 4 or 5% right now. I call bullshit on that. I have said all along that the neutral interest rate is basically the same as the target inflation rate, which is 2%. So the neutral interest rate is probably in that 2 to 3% range. And that is where we're going to head to by 2029 for sure. But with the Treasury issuing a lot of 2-year debt, I would say within 2 years. Janet Yellen, in a recent testimony to Congress, was questioned by some knucklehead Republican senator about why aren't you issuing 30-year debt at 5% instead of 2-year debt at 5%? And she said, because interest rates are going to come down. I don't want to lock in that higher interest rate for 30 years or 10 years or 20 years. She told him the truth, and he had a conniption. What we are seeing with the excess printing of short-term debt, trying to see if my chart came back, did not. I had a chart for this, but it got pulled off the web. I didn't download it. There has been a lot of short-term bond issuance, 2-year debt, some 5-year debt. Over the next 2 to 5 years, and if I show you the chart, it really jumps up. In fact, I think I could probably find it on TradingView somewhere. You're going to see interest rates come down a lot in that 2 to 5 year window, which jives with the term structure of the bills that they've been issuing and when the last baby boomers get on Medicare. So while I think we see some QE over the balance of this decade, I think most of it kicks in around 2029. Again, plus or minus, having to do with the boomers hitting Medicare age. But we can shave off $35 trillion debt, lots of zeros. We just cut the interest rate by 2%. We shave off $700 billion from the debt. Suddenly, the deficit is only about $1 trillion. What do we know is happening at the end of next year that will raise somewhere in the realm of $600 to $800 billion? If the Trump tax cuts on the top 1% expire and everybody else keeps it, but if you're in the top 1% and your tax cuts expire from 2017, just that group, the economy remaining about the same, you're going to see $600, $700, $800 billion lopped off the deficit. With growth of the economy, suddenly that $1.9 trillion deficit comes down to maybe $1.2 trillion because of lower interest rates, maybe $0.5 trillion with higher taxation on the 1% in corporations, not affecting anybody else. And if the economy continues to grow because of AI and the energy transition, and all this investing in U.S. manufacturing, If GDP grows between 2 and 3% per year with 2 or 3% inflation, you have a balanced budget pretty quick. That is the real path that we're on. And it's coming into focus now. And I told you this was going to happen. What? Somebody tell me, when was the first time I talked about the US having a balanced budget in the 2030? 5 years ago? These things are projectable. Teresa says it's been a while. Yeah. I've been talking about the US probably having a balanced budget in the 2030s since 2018, 2019. I might have first mentioned it in like 2016. So all the people who are pounding their chest and stomping their feet and yelling inflation is forever, even though inflation month over month is zero, don't really understand what they're talking about. And I get the people are afraid of things that they don't understand. And that's why it's loud. But the US economy is in pretty damn good shape. Now, could the Fed make a mistake? Absolutely. But it doesn't look like they're going to. We'll see. If suddenly Powell gloms on to the inflation narrative, then I think that he's making a mistake, because it's pretty clear that things are in good shape. We have successfully had a soft landing on the economy. At the moment, we are in the Goldilocks zone. And the only question that remains is, can they keep it there for a while so that AI can start to yield actual tangible benefits and the energy transition can continue? Even if President Trump wins, the odds of him getting all of Congress are pretty slim. And even if he got that, the odds of them really wanting to get rid of tax incentives that big oil is using for carbon capture and to finance their own energy transition, notice Exxon and lithium, Occidental and Chevron and carbon capture, Conoco and carbon capture, the odds of the energy transition being short-circuited are almost zero. Almost zero. Even though the Supreme Court is trying to make the next president a king. Let me ask you something. What if the next president king is a Democrat? Then all these powers that the Supreme Court is trying to confer on the president and the courts suddenly falls onto a Democrat president with a Democrat attorney general. Then all those things accelerate, don't they? So while Trump may slow things down just a little bit, just enough to cause a stupid recession, which for us would be a buying opportunity, and you probably want to stay out of certain neighborhoods. In the long run, the wiggles in the line probably end up in the same spot about 10 years out. So really all we're trying to figure out is how the line wiggles. Now, I don't think, and we'll just talk about this for a second, I don't think President Biden's going to be so defiant a week from now. The poll numbers don't look good. You have members of Congress telling him to step down. Suddenly, Kamala Harris looks like the candidate, not Gavin Newsom. Now, I will make a prediction. If the Democrats do the smart thing, and I don't know that they will because they certainly screwed up with Hillary, maybe Democrats go, hey, let's run Kamala with Gretchen Wilson and have the first woman ticket in history. If they do that, they win in a landslide. There are a lot of paths for Democrats to win, even if the old man runs. I was sitting with my cousin on the 4th of July. He's an artist, pretty good one. He's gotten flown around the country to do art shows by people who want him there. I said, hey, can you do a sketch for me? I'm going to give you the caption. You figure out how to draw it. Con man, an old man, and a crazy man run for president. You draw it. In your head, what did you just draw? So I'm actually going to put an article on Medium to that effect if Biden doesn't drop out in the next week or so. We'll see. He's being stubborn, as old men are apt to do. I'd still vote for the old man instead of the con man or the crazy man. But there's better paths, and I think we're probably going to see one. I still go by that. Only a stubborn old man could thwart that. Everything says it's going to change. We'll see. Either way, all it does is change the wiggles in the line. And by the laws of reflexivity, if Trump wins and screws things up for a little while, which I think would be an almost certainty, the snapback would be very strong. So whether Democrats win now or in 2028, I think you're probably going to see just changes in the wiggles in the line. Demographics strongly suggest, remember, Biden won by 8 million votes last time. Now we have 6 or 7 million more immigrants in the country when you include children. They mainly skew Democrat. And this is not to say that I don't understand the complaints and the concerns of people who support Trump. I wrote an article about that years ago. People in the heartland, people who've been building things for the rest of the country for a long time, feel like they've gotten shortchanged by elitists on the East Coast, New York and Washington, D.C. I think it's pretty legitimate beef. Trump tapped into that. The Democrats have made a mistake not to talk about it more. They push class warfare more than solutions. And I think that's largely because the spokesperson for the Democrats right now, President Biden, isn't a very good spokesman anymore. I don't know that he's a bad politician, a bad administrator, but he's not a good spokesman for sure. And that causes a lack of excitement. That causes a lack of hope that he can get the job done, just the way it is. I'm not saying that I don't think he can get the job done. I think he's done a pretty damn good job, actually. But if he can't win the election, what difference does it make? So we'll see. We'll see what happens. Our job is to navigate the wiggles in the line with an eye on the long term. Slow-handed ebb and flow trading. We don't have to be Nietzsche. We can take a look at what's happening and say, okay, we know this relationship exists. How do we deal with it? We know that velocity money is going to drift higher over time. What do we do about that? You buy the dips. Buying the dips has been the best strategy in investing forever. There have been a couple of periods where the stock market round tripped over about a decade. But the stock market, everybody thinks about it as the S&P 500, and it's so much bigger than that. During the 70s, when Buffett really separated himself from the market, it was a choppy market. It didn't really go up. But he made billions investing in small companies and picking the winners out of the big basket. If you're a stock picker, you should not be afraid of whatever's coming ever. You just have to make smart selections. If you're an indexer, might not be so great for you. But I will throw this out there too. I believe there's a good chance that we start putting around a quarter of the Social Security Trust Fund into, that's the S&P 500, and then the mid caps, and then the small caps. So 500, 400, 600. And the reason we might do S&P is because there's a profitability requirement. So if suddenly a quarter of the Social Security money collected went into the S&P 1500, basically the 1500 profitable biggest companies, what would that do to the stock? Remember the relationship between taxation and the stock market. It's almost perfect. When the stock market and real estate prices go up, tax collections go up, even with the capital gains tax break on selling your own home. So what does that mean? Where does the big profits from real estate come from that the government collects some taxes, even with 1031 exchanges, which is a law that should be amended. It should be amended that you can't sell one property to buy another property if there's no property improvement. You should only get the tax break on improving a property, not just swapping with another rich guy. And I think that's coming too. The big opportunity in real estate right now is if you can get commercial real estate cheap enough and then convert it into residential, or just find a way to use it in a commercial purpose. Because those prices are coming way back down to below 2019 prices, all the way back to like 2014-15 prices. Another interesting place to invest are regional banks that have gotten clobbered that find new capital. The first one was New York Community Bank Corp. There's going to be more. You don't want to invest in those banks before they collapse. You want to invest in those banks right after they collapse, and they get the check from private equity or whoever is going to facilitate merging banks, because that's coming too as the commercial real estate crisis plays out over the next 18 months. 1/3 of all commercial real estate debt is held by the regional banks, and it's in pretty big trouble. $2 trillion is out there that's at risk. 700-800 million of that is with the regional banks. They can only survive that by merging with other banks, then taking a facility from the Fed that comes with contingencies, and then taking private investor money that dilutes them. Wait for the dilution to occur and for the sentiment to bottom before you invest in regional banks. The blueprint is New York Community Bank. Other banks are going to follow the similar thing, and then the consolidation will happen. The NASDAQ consolidation happens, all these banks go up. But you got to buy them off the mat. You don't buy them now. New York Community Bank Corp is the first one. We'll see who else collapses. But as they collapse, don't run away going, oh, they took my dividend. You shouldn't have been in them in the first place. But that is something to watch for, and it's imminent. As these banks have problems, and they dilute, and the Fed has to help them, and the FDIC has to help them, and the sentiment gets horrible, and the prices drop 60, 70, 80, 90%, when you see private equity come in with a check, or you see Berkshire Hathaway finally start a bank corporation, I think they'd have to do it on the side. I think they'd invest in a bank like they have, and then finance it to do the consolidation. So I think it's very likely that you see Berkshire Hathaway buy a couple of mid-sized banks with the idea that they will give them the money through favorable loans, probably not super favorable because it's Berkshire Hathaway, but they might buy stock in a Fifth Third after it's down 30, 40, 50%, with the idea that Fifth Third is going to buy 2-3 other banks with a Berkshire Hathaway check, similar to the Occidental Petroleum. All right, so what should we expect with interest rates coming down? What asset classes will do well? Small caps will do well. I talked about oil for a number of reasons. One of the reasons was oil right now, because China is outrightly, just flat out defying sanctions on Russia, and India is doing it in a more discreet way, but they're doing it too. These are two giant markets that need oil, and they're settling the oil in local currencies and in gold. Gold is probably going to go up pretty significantly here. It's going to get to that 3,000. I don't know if there's a lot of trading you can do with that. You can try. If you want to buy GLD, go ahead and do that. Don't buy the miners. Too much capex. But if you want to buy GLD, I believe we had a little dip here recently. I'm not sure it wasn't. It's just jitterbugged. This is where I said in here, start of a new bull market in gold. Pretty good call, right? I didn't really expect it to run like this. I didn't fully wrap my head around the oil angle here. So now we're getting some jitterbugging, and I will tell you, I expect this to really break out here at some point. And we're going to get $3,000 an ounce gold. And then it'll probably chop again for a very long period. So you can trade GLD. I would do it with options, but you can own a little GLD if you want to. It should only be a single digit percentage of your portfolio, but this probably breaks out. Bitcoin is the other thing that's probably going to break out. I mentioned this the other day, and I forgot all about the other thing. But you have the German government selling off Bitcoin because by law they had to. And then you had Mt. Gox with, I forget how big the settlement is, but they're settling a bunch of things. And that's putting Bitcoin into the hands of individuals. And a lot of those individuals are selling the Bitcoin. And the miners, for a minute, and they're done, but the miners are selling Bitcoin too after the halving. So this correction is about done playing out on Bitcoin. Can it go down to that yellow zone? For sure. But you should be looking at adding to your Bitcoin holdings to whatever your maximum asset allocation is. Again, I'm at 25%. You probably shouldn't be unless you're super aggressive. But a single digit percentage in Bitcoin, I think, is a must. If you want to inch into double digits, go ahead. And remember, think about your position in terms of capital committed, not what it grows to. So if you put 8% of your money into Bitcoin and it doubles again, that doesn't mean you have to sell. You could, maybe you sell a third of your gain or something. Just bring your cost basis down. But right here is your resistance that now is turning into support. The next level up on Bitcoin, I guess it doesn't matter. Market cap is fine. This one works too. It's been a while since we played with the chart. This actually works really well. But again, resistance turns into support. We're at about 57, 58,000 on Bitcoin. I think you get up here by the end of the year or early next. And why is that? Same reason as the oil being transacted in gold settlement. You're starting to see Bitcoin being used for big settlement transactions. It is becoming digital gold, which is what people have hinted at for a long time. You're seeing OPEC nations buy it. You're seeing African nations buy it. You're seeing Central American and South American nations buy it. China. What happens in India starts to buy a lot of Bitcoin. Bitcoin is becoming an international currency hedge, and we're at the very front end of it becoming a settlement mechanism. Settlement mechanism meaning you can buy stuff or back a transaction. So Bitcoin heading to 100,000, I think, is easy. I think heading to 300,000 over the next several years is probably pretty easy. And when you think about how big Bitcoin could become, you realize that the market cap should get to between 30 and 50 trillion and become the third or fourth biggest currency on the planet. After the dollar, I think after the yen, and after the euro, and I think bigger than the yuan. And maybe euro doesn't survive or do quite as well as they hope, right? If the euro drops to 80, 70 or 80 on the dollar, they're going to hate that. They might kill it, and they might switch to Bitcoin. So we'll see. I've had the pricing on this pretty well. Remember, back here, he had the interview with Sean Stein-Smith, where I said it was going to, he said it was going to go to 100 when we were up here, and I said it was going to go to 20 first, and we got 15. And I told you to back up the truck in here, and now you're getting a correction. Don't miss this opportunity to buy Bitcoin. To go a little lower, it can always go a little lower, but it's got a lot of room to the upside. Understand what is happening to it, and you will be more comfortable with this decision. It is becoming an international currency. It is becoming part of the international currency basket, and it's going to replace a lot of small nation currency. Take a look at Argentina. All right, that is our quarterly outlook. I stretched it out to the next decade, but tried to bring it back to what to do now. Small caps, Bitcoin, corporations that will benefit from employing AI. I think that's your trifecta. If you want a little gold, go ahead. Make sure you're getting into the chat room. I'm there a lot. Teresa's there a lot. Shooters over at Fundamental Trends. Shooter just posted his Elliott waves for the punch card growth stocks. I will put this up over at Margin of Safety Investing. This is a pretty good piece. He did talk about a Metis, which somebody just asked about. If you know that a bunch of shares have been soaked up from the float and you can see that the cost of borrowing shares has gone up, and you can see, which we can, that failures to deliver have ticked up, and that prices in a choppy area, that your Bollinger Bands are getting closer together, that your RSI is way down low, you just know you're getting closer. Can I tell you what week it's going to happen? Maybe probably not until the week it happens, until it starts to happen, but it's getting closer. You need to think with small caps in 3 to 5 year periods. Anybody who's trying to think in 6 months to 1 year, you can only do that if you're a very good trader. Otherwise, just use the price dislocations to get your positions for the longer term. And remember, scale and slow and at wide price points. You don't, and I'll give you an example. Have a mythical stock, the alien widget company, and you really like it. And you think over the next 3, 4, 5 years it can do really well. And it's trading at $10. And next week it goes down to $9.50. Should you buy more? No. Why? Because you're not really changing your cost basis. What if it goes down to 8 or 7? Yeah, now maybe you start to scale in a little bit or sell a cash secured put. I like the cash secured put. You should only scale in at double-digit percentage decline. It's only dropping 4, 5, 6, 7%, even 10%. That's a normal volatility. Those 20 and 30% drops is where you start to go, let's reevaluate my thesis. Is it still correct? Okay, it's still correct. Is there still price momentum to the downside? And this is the answer to your question. If there's still price momentum to the downside, you don't buy. If it starts to chop sideways, you can nibble a little bit more. Doesn't mean it won't fall off a cliff again, but a lot of times those sideways movements, especially if they extend longer than 4 weeks, and especially if they extend 8 to 12 weeks, those are pretty good shelves. And that's where you scale in. All right, let's call it a day. It's still 4th of July weekend, a very long weekend, and I have a lot of work to do, but I think it might be warm enough to go swimming, and I have burgers to cook. So everybody have a great weekend. I will get this posted. All right, take care, folks.